So yes, it's conference season, and yes, I'm pretty much doing at least one speaking event every week for probably the next 11 weeks. So very, very busy. And so this is a great presentation. I'm really happy to be here because this is a part of the industry I don't get to spend very much time in. So I appreciate learning from you guys. Hopefully you can learn something from this presentation. It's essentially going to be an industry update looking at what we're seeing going on in the auto finance space.
Okay.
So session's 45 minutes long. We'll probably have about 35 minutes of content. Open it up for some questions at the end. I will be around this evening, so if anyone doesn't want to ask a question in the room, feel free to come up to me later tonight and ask any questions. So going to cover a little bit of what's happening for overall origination trends, focus a little bit on the new car market, because obviously new cars today become tomorrow's used cars. Then we're going to dig into a deeper dive into used vehicle sales, take a look at leasing. All this is, we're going to be looking at affordability and market share and who's doing what. And then we're going to end on the happy note of delinquency. I like to start with delinquency and get the bad news out of the way, but I don't think increased delinquency is a surprise for anybody. So we're going to dig into that. As far as the time periods go, we're essentially looking at January through July, unless otherwise noted on the slide. And we'll have a several-year trend line that'll correlate to everything. So at a few occasions, I do use some score rankings, and you can see what those credit scores correlate to the side. We do not use FICO. We use Vantage Score. For anyone in the audience who uses FICO, you can probably imagine why we don't in these presentations, because I'm scoring millions and millions of records, and they want to charge millions and millions of dollars to score millions and millions of records. So we use Vantage Score 3, similar score ranges, as you can see on the slide. Just a little bit about the data source. This isn't sample data. We are one of 2 companies in the country that receives title and registration data from all 50 states. We match that with OEM retail delivery records and various other sources. So when we're talking about what we're seeing in auto finance, we're looking at the entire market. You know, it doesn't have to be something that is reported to Experian as a credit bureau. We're starting with titles. So we're just looking at the entire market. We do, of course, dig into our credit databases when looking at delinquency. So there will be some situations if you are, in the buy here, pay here space, if you're not able to report data, then there's that little bit of credit invisibility to us there. So there will be some of those nuances, especially in the buy here, pay here space. Okay, so starting off with what we're seeing for some origination highlights. Now, I know, so this is the awkward time to do a really data-intensive presentation. The lights are kind of bright, so I can't see if you slip under your tables. Okay, so I'm a data-intensive presenter. So when we start looking at the new car markets, we have new car at the top, used cars at the bottom. This is, again, first half of the year, January through July trend line from 2019. Now, of note on the top, of course, we have the reduced new car volume in 2020, but the key thing to take away at the top part of the chart is the return of fleet. So fleet on the new vehicle side, it's about 1.7 million. It's the highest it's been so far for this part of the year since 2019. So fleet is recovering well. We're not competing with fleet at the auctions anymore. The volume is still a little on the lower side compared to that 2020 figure or 2019 figure, but fleet is returning. So that is a good news. As far as the used vehicle registrations, you can see so far we're at about 23.5 million used registrations. So higher than it's been for the last couple of years, and pretty similar to a little bit lower than 2019, but again, used vehicle registrations are kind of booming again. We're at least growing that used car park. Now, the rest of this presentation, we're only going to be looking at retail for both new as well as retail for used. So we're going to ignore that 1.7 million fleet. And on the used car side, we get a little bit of used fleet, but it's very, very small. Very, very small. Okay, I know I'm pointing at the screen. There we go. Okay, so how does the market transact when it comes to retail? So with the increased interest rates, a very surprising thing happened. As rates went up, we saw cash come back. We saw a lot of cash enter the market. This, of course, it's at the same time rates are going up, affordability is becoming a concern, but on the upper right-hand side, as we kind of go around clockwise, that's the percentage of vehicles with financing. Now, if you look at that trend line and you drag it back like to 2015, 2008, I've been doing this since 2007, every quarter since 2007, that's a lot of quarters. We would typically see cash at about 15% of new cars, and typically, 60% or so of used vehicles. Sometimes a little less, sometimes a little more. But lately, we're seeing cash at 20% for new cars, and we are at a record peak of cash for used vehicles. So we have not seen this much cash in the industry really ever. It's about a $40 billion hit to our portfolios of just loans not being booked. So we didn't expect to see cash this high, but we certainly are. Now leasing, we're starting to get leasing come back again, really tied to inventory availability again, incentives are back. So leasing is returning. We're about 24, almost 25% leasing from the trough that we had a few years ago. I don't expect we're going to get back to that 33, even as high as 36% that we saw, because leasing is expensive. So 25% is about what we're doing. And with that availability of inventory again, more of what is being financed is being made up of current and late model vehicles. So the current and late model is a little over 61% of the entire loan space. Now, of course, when we do look at the financing, captives. When the captives started running their incentives again, their market share went up extremely dramatically. This is share of total financing, new, used, loan, lease, to the entire market. And as you can see, captives are the largest lender type, a little over 30%. Bank share has been steadily dropping, and a lot of that was due to some of the banks leaving the market. We had 2 or 3 banks that left indirect lending, that left auto completely. And the credit unions in that purple line, their share has been dropping, also a bit more strategically. They put on a lot of business. When the rates went up, they were very slow to raise their rates. They became the largest lenders out there. They became the largest used car lenders, huge market share. But also during this time, we weren't originating as many mortgages. So the credit unions became really overweighted in auto. So they've been pulling back to a certain extent. You'll see as we get into the used section, they're still the largest used lender. And then the buy here, pay here, other, the reason I have that combined as other is if you've ever dealt with titling, the sheer volume of name variations and wackiness that ends up as the lien holder on titles. So some of that gets mushed into my buy here, pay here category. And I do classify buy here, pay here as a lender type, not a dealer type. But as you can see, the buy here, pay here space has been right around 10% of the entire market. There we go. I think there's just a little delay. I'm expecting it to click immediately. So I know I talked to a few folks last night around credit scores, because credit scores are continually increasing, and I do expect to have probably some questions around this. So the score increases that we started to see were caused in part by the government monies that came out during COVID, but they had been steadily increasing prior to that. So this wasn't just this knee-jerk reaction. If you take a look at, we've got a chart that scores average credit score of the entire credit population, and it's been steadily increasing for years, which is also why we highly recommend, if you are doing scoring, everyone's redeveloping their scorecards right now, because the consumer behavior today is very different from what it was a handful of years ago. So we highly recommend redoing scorecards, no matter who you're working with, use the latest scores possible. Part of this also, we're looking here just at auto. I still am firm belief that a lot of the subprime consumers are simply being kept out of the market due to affordability, or again, going into an area where we're not able to see it in the data because it's not getting reported. So here you can see the rank of just looking at the distributions across the risk tiers. Most of the car market is very prime. This is total loan, lease, new, used. And again, the majority of it, almost 70%, is prime. But look what's happening to subprime. And that very bottom one, that light pinkish color, that's deep subprime. That's 500 and below. It has been cut in half. Now, it's been cut in half across the entire credit population. You had a question?
Do these numbers include the 10% that you had buy here, pay here on the last slide?
It would. So this is coming from looking at all of those titles, taking the car buyers and going to look to see if we can find a credit report on them and credit score them. So some of that buy here, pay here will fall out because we have to be able to score it. And some of them might be very, very thin files, although Vantage does do a good job of scoring more thin files. But if they also don't have any credit, they're not going to get captured in this. But you can pin it. You can see exactly in 2020, 2021, that subprime consumer is kind of originating like this, and then it just completely falls off. Near prime's coming back, but it's that deep subprime that we're just seeing across all of credit is just really just not coming back. So we're just not seeing it in the data. So let's take a look at what's going on for new vehicle financing. So I mentioned a little earlier about what we're seeing from leasing. So this gives, again, a little look at leasing for new vehicles. And again, we're right around 25%. But the impact of those lower levels of leasing are going to start to hit the end of this year. So on the bottom, we're looking at our anticipated off-lease volume. Now, historically, when leasing was up in the 30% range, 3 years ago, we were bringing back 1 million off-lease vehicles every single quarter. Now that we dropped to 17%, 18% the other year, that volume's going to start hitting this quarter. This year completely, we're still looking at about 3.6 million off-lease vehicles. So again, late model, used vehicles coming back. Next year, that drops to 2.3 million. So we're losing over 1 million off-lease vehicles. Now, right now, we know that the auction values and the used car values are kind of holding stable. They're coming down a little bit. I don't expect that to continue, as we're, again, going to have heavy competition for these late model vehicles, which is what consumers want, and that volume is going to be dropping again in half. So that's something to be on the lookout for, especially next year. It comes back a little bit in 2026, and then as we roll into 2027, we'll hit closer to around 3 million. And again, this does not take into consideration any of the fleet leases. So this is just purely on the retail side. So as far as also what consumers are purchasing, again, I like to talk about this on the new car side because this incredibly impacts our used car availability. And when we look at the fact that lately, almost 65% of everything we buy is an SUV. So it's kind of hard to see the room. Anyone bought a car this year? Got a couple. Who did not buy an SUV? Oh, surprisingly, a couple. Anyone buy an EV? I didn't. So I have a 125-year-old house in Colorado. I had to completely redo my power system, so that's just not going to happen. Also, I live in the mountains, and it's cold. So, I'd have to push the EV. Okay. So 64% SUVs. We're still doing the majority non-luxury, 80%. Now, EV is the exact flip of that. When you look at EV, EV has been kind of stagnant lately. It's around 8.5%. That hasn't really changed for the last several quarters. So there's more and more models coming out. There's more affordable models coming out. With the tax incentives on those, we're seeing EV purchases, 48% are leases. And some of the models, like the ID4, is like 80% leases. So depending on the model, really heavy leasing and really affordable vehicles. But the volume has been pretty flat. Now, where the volume is growing is in hybrids. Hybrids are now about 10%, and that's doubled in just the last couple years. So it's the hybrids that we're seeing it. But when we do look at EV, most of it's luxury. There's not a lot that's in the non-luxury category. And ICE is still the majority. And also, when we look at the car park, there's like 260 million vehicles on the road. It's fewer than 2% of households have an EV. So even though there's so much noise about it and so much talk about it, it's a small percentage. Now, when we do look at the new car market, when the captives started coming out with their incentives again last year, their market share grew tremendously. 60% of all the new car purchases are financed by a captive, whether it's a loan or a lease, 60%. And you can see again in the buy here, pay here space, very small, right around 1%. The bank share has been steadily dropping here also, as has the credit unions, because it's really hard to compete with 0%. What's been starting to see with those incentives is we're finally starting to see the 0% and 0% at 60 and 72 again. I'm not really seeing any of the 0.84s yet, but we're certainly back to the 72s. Whereas in Q4, when the incentives were out, they were mostly 36-month and 46-month, or 48-month, which is why we saw the terms come down. But captives dominating. Now, affordability is still an issue. For those that bought a car this year, might have been a little bit of a surprise. I mean, you're all in the industry, so you know about how all the prices went up. Now, for the new vehicle side, we're starting to see the loan amounts come down a little bit, but it's almost $41,000 for a new car. Now, I'm only doing a 3-year trend. If I were to add 2019, $33,000. So we've gone from just a handful of years, $33,000 for an average new loan, to over $40,000. Payments, $737. The payments haven't changed that much in the past couple quarters. They're really holding steady at that $737, $735. And even with incentives, the average rate is still, almost 7%. Term, a little bit down because some of those shorter term incentives. Now, the reason I also like to point out that $737, your average consumer, and again, just average, the average consumer who's coming back to market right now, their last car purchase was just about 5 years ago. It's about 4.7 years. 5 years ago, the average new car payment, anyone want to guess?
$550.
Little bit lower. It was about $535. Oops, went the wrong way. So to make it even more shocking, take a look at the bottom of this chart. These are leases and loans, distribution by payment. So right now in the F&I office, everyone's kind of coming in going, I'm still wanting that payment under $400. Well, no, 10%, $400. But look at how many payments are over $1,000. 16% for loans. In total for new car, it's 13%. Just wait till you see the used car numbers. So yes, over 1,000. And it's not Highlines. These are RAV4s, CRVs, high interest rates, 60 to 72 month terms, and you're over $1,000. And think about the F-150. I got teased once because I am a huge Porsche fan. I was lucky enough to have a couple Porsches in my life, bought them used. I was harassed by a coworker because, oh, you're driving up in this fancy Porsche. I'm like, your truck costs more than my car. So there. But no one harasses a F-150 driver. Okay. All right, let's look at the used car market. I think that might be of interest for you guys. Okay, so when we take a look at used, I always like to kind of start off with just a little bit of, where are consumers buying their used cars? We used to be a little bit more even split between franchise and independent stores. Right now, the used transactions are about 46% independents, almost 54% franchise. You can see that varies a little bit based on inventory. With the new inventory being back, we're seeing a little bit of shift more again to franchise. And the biggest change we're seeing on this is kind of that who's doing the financing. On the right-hand side, you can see for the independents, the banks are only doing about 15% of the financing in the independent stores. A handful of years ago, that was about 25%. The banks have really pulled away from the independent stores. This is just where there's a dealer involved. And you can see buy here, pay here, it's the majority of financing in the independent space. You get a little bit of it in franchise, and on the franchise side, we still have the banks as the largest lenders. Now, when you're thinking, well, what about market share? So when we look at market share, that's a slightly different figure, which we'll see is because that also includes private party. But the bigger thing that's impacting the used car market right now is the average age of the vehicles are growing. So on the left-hand side, we're just looking at the franchise independent grand total, kind of across the top. Average age of the vehicle by year, right now, for cash, it's up to 14.86 years. On the loan side, for the total market, it's about 6.5 years old is the average age of the vehicle. And on the independent side, you can see it's now 7.8, franchise 4.53. So this takes new cars out of it, so getting rid of new cars. Just looking at the average age of the used car being sold is increasingly getting older. Now from the consumer, that starts to become a challenge when you start getting into some of those older vehicles, especially if you're looking for mainstream lending, because your typical bank anyway is maybe going to do current plus 8. So you're not going to be able to get to some of those older. They might do 9, but they're not going to get into 10-year-old vehicles. And that's to get a payment under $400 by model year. You're in a 2013 or a 2014 model vehicle. So a lot of lenders won't do that. So age is growing, and I know a lot of numbers on here. So again, talking about that, older vehicles older than 10, if you take a look at the top is the franchise, current plus 8, used 9 plus years. And right now, franchises are doing about 15% of their sales are over 9 model years old, and the independents were now 50%. So 50% of the independent sales are 2014 and older vehicles. And again, you start losing financing on those. Now again, I started mentioning market share. So when we take a look at our market share, the reason this might look a little bit different from the slide showing the share by dealer type, because this includes private party. So when we take a look at the entire used market, credit unions are still leading, but it's kind of duking it out for banks. And this is where you can see that buy here, pay here has lost a little bit of share, but still holding around 16%. So a little bit down over the last couple of years. And the captives have been pretty steady on here. But I would anticipate the credit union share to continue to drop. Where I don't expect it to drop is as we start having rate decreases, the refi market is going to just boom. We've had so many lenders already approach us asking about refi and when we think it's going to start coming back, how much it's going to take to flip a consumer. Usually if you can save a consumer about well, before the loan amounts went so high, if you could save a consumer $25, they would refi. And that's probably going to pick back up again as the rates come down. We're already starting to see refi volume increase. So it's already starting. And it's going to go to credit unions. So watch your portfolios. So as far as the used lease share, when I look at the data for used leases, the majority of it is captive, and it tends to be a lot of dealer service cars. It's 1 or 2 model year old vehicles coming in from the dealer service lanes, being financed again by the captive. A lot of it also are those off-lease vehicles. They're 2, 3 years old. And then you can see in the buy here, pay here space, you've got about 10% share of the used lease market. Now that's down from 2019. You can see that I do not know what happened in 2022 and 23 to the used lease space, because you're going to see the numbers look really different between then and now. So I need to dig into the numbers a little bit more and see what's causing some of that. But that almost 40% share on captives, it's a lot of BMWs, it's a lot of Mercedes. So, dealer service cars. I think the first time I saw a lot of volume from BMW, I actually called a friend of mine over at BMW Finance, and I'm like, "You're doing used leases?" He's like, "Yeah, they're dealer service cars." So that is what a lot of those are. Okay. Come on. There we go. All right, so apparently you have to lean when you push the button. Okay, so like I said, 2022 saw used lease volume really start to drop. So this is the used lease volume over, from 2019 to 2024. The number above that is the average age of the leased vehicle. So is the average age coming up? Is it going down on the franchise side and the independent side? Over the last couple of years, the average age of the used lease volume is decreasing, but the volume is also quite a bit down. Now, if you're trying to sum up these numbers and you're like, hey, the grand total doesn't equal the combination of the franchise and the independent, because we don't get dealer information on everything. There's 33 states that the DMVs provide dealer on title, and we have some other data sources, but the grand total will include just every used lease, regardless of whether we have dealer or not. So far for the first part of this year, we're about 180,000 units, whereas a handful of years ago, you were 230, 250. So the used lease volume definitely down, but the vehicle is getting younger, and again, a lot of those 1 or 2 year old vehicles. Now, one reason we do look at the used car market, of course, our loan amounts are starting to come down. The vehicle values were coming down. We're about $26,000 for an average used vehicle. And again, that consumer that's coming back 5 years ago, that's the average monthly payment for the new car. And 5 years ago, anyone want to guess the average used payment? Anyone?
75?
Definitely higher. So it was around 380, But going from 380 to now 525, that's a big increase. So 525 average used payment. It's been hovering around that a little bit. It's a bit down from last year, and actually Q2 of this year, it's about the same, around 525, 528, but it is down from last year. Terms are still 67 months on average. Now I do in my quarterly presentation that we put on our website, break the term out by risk tier, and one of the biggest growths that we see is that deep subprime on used. Like I said, my data tables go back to 2007, and then it was like deep subprime average term was like 40 months, and now it's 60. So a lot of increase in term. For those of us who have been around quite a while, I'm sure you look at some of these terms, and anyone in the room remember when 48 was considered a long-term loan? Yeah, I came across a Fed paper from, it was like 1978, and it was really strict and concerned about the long-term 48-month loans. And they were just going to cause havoc. Rest assured, long-term loans do not keep consumers out of the market any longer. The consumer still comes back. And interest rate still around 12%. Okay, so when we take a look at the used lease market, though, we saw a really big increase in payments from 2022 to 2024. So as you can see, the used term is coming in right now for the entire market, just under 35 months. It's a little higher on franchise. And the payment, though, look at that, it's almost $700 on the franchise side, and almost $600 on the independents. So even on the used leasing side, we are seeing payments higher than some of those loans, which you've got consumers moving into leasing for the lower payment. But on the used side, we're not really seeing that. So taking a look at the payment distributions, again, the first place you go is that bottom line, over $1,000. We have approaching 5% of franchise payments are over $1,000. Even on the independent side, you got 2.5%. Doesn't sound like a lot, but still 2.5%. Now, we still do have about a third of our used payments are under $400, so consumers certainly finding more affordability on this. And this is just on the loan side. The payments certainly increase when we shift over to look at leasing. So on the leasing side, on the franchise side, we're seeing almost 13% of those payments are over $1,000, but even on the independent, a little over 7%. And in total, it's approaching 10% for over $1,000. But again, we're still finding a lot of availability of payments that are under that $400, especially on the independent side where it's about 25%. So let's wrap up with the happy delinquency information. Does anyone think it's up? Show of hands. Delinquency up? Yes. You are correct. There's no prizes, but you are correct. Okay, so before we get to the delinquency, though, I'd like to talk a little bit about the outstanding balances and some of those risk distributions of said balances. Because of the increase in cash, our total book of portfolio growth has slowed down. We're, however, this is a really big number, $1.4 trillion in open automotive loans. That is big. Now, the growth rate, though, is only about 2%. We had been growing like 8, 9%, but with the increased cash, we're not seeing the growth rates nearly as much as we had. Again, just last year alone, it was a $40 billion hit. And we are seeing a little bit of growth in our subprime balances, and part of that, of course, is because of our increased levels of delinquency. Now, speaking of delinquency, let's start off with 30 and 60. So what we're seeing here is the top is the percentage of loans and leases that are 30-day delinquent, as well as 60 in purple. Below that is the percentage of balances. So again, that $1.4 billion, 1% of $1.4 billion is 60 days delinquent. So it is up. You can certainly see it's higher than it was pre-COVID. And we're at about the same level as we were when the delinquency hit its peak in 2009. So we're at 2009 levels of delinquency. Now the good news here, if that's considered good news, is people planned for it. This wasn't a surprise to anybody. We expected it to go up. 2009, no one expected those delinquency levels. So we expected this, and I'm going to get into some charge-offs and repos, but keep in mind when the loans went bad, they went to auction. The auction values were tremendous. So severity losses went down. So that was something that was a positive. Now, repos, we're starting to see repos come back. We're about, I say that like it's a good thing. Yay, repos are back. So 1.44% repo rate is what we're seeing right now from a unit standpoint. It's higher than it was in 2019, so it certainly is growing. Some of the areas where we see these repo rates increasing at higher rates, this is prime. So Prime Plus has more than doubled its repo rate. So it's still a very low percentage, but it's more than doubled, and the red line is the balances. Now, the area that is of concern is this one, near prime. This is a consumer who is 600 to 660 credit score, kind of near prime, not horrible, not great, but near prime. You don't expect to see the repo rate go up as much as it is. This is also a consumer that is now representing 11% of all the repo balances, up from 5%. And I got to tell you, even though you can't make decisions on age and all those things, it's the Gen Zs. They are increasingly representing a large, sorry if any Gen Zs in the room. Usually in the auto industry, you don't get many Gen Zs in the room. But they are increasingly representing a larger portion of what is going delinquent. So from a segmentation standpoint, keep an eye on them in your portfolios. Now, the subprime repos are growing. They are certainly higher than what they were in 2019, but they're pretty flat year over year. And then we'll look at just deep subprime. Deep subprime is doing pretty well from a repo standpoint. They are down. So again, it's that near prime area that is where more of that focus is going. It's also the near prime consumer that's starting to hit alternative data more. So again, it's an area to really, really pay attention to. And then lastly, we'll just take a look at some charge-off numbers, and hopefully I might be running out of time. Am I running out of time? I'm talking a lot. Okay. These are monthly. Yeah, this is a monthly trend line that starts in January of 2019. The numbers that I highlighted are August of each year. August 19, August 23, and August 24.
It's not annually adjusted. Those are monthly percentages, is what you're saying?
Yes, it is. As this snapshot, this is the percentage of loans that have this status reported on them.
Wow.
Yeah. Now, some of these statuses hang around for a little while, but deep subprime, like I said, the charge-off rates are doing well. And again, the charge-off rates were improving because the auction values were so strong. So, we were doing pretty well there. So this is overall. And then again, when we take a look at how the different risk tiers are performing, just a couple last ones. Come on, click. There we go. Same thing, prime and higher. Year over year, kind of flat, but elevated from 2019. And then when we look at that near prime, again, this is the near prime consumer. This is where a lot of the concern is right now, because again, we've gone from 4% to almost 5.5%, and they're representing now 15% of the charge-off balances. And then we see some similar stuff with subprime. Subprime, a little bit up from last year, but kind of easing back to the 2019 levels. And then lastly, again, deep subprime, still high numbers, but considerably healthier than it was in 2019. So with that, I think there might be a few seconds for questions, and again, I'll be around this evening. And that's what I have. We'll leave you on that delinquency slide so you can look at numbers all day.
That was
Any
great.
questions?
That was great, Melinda. Yeah, go
Thank
ahead.
you.